Hey everyone, Stephen Morris here with AdviseRE, and today we're going to go over a brief topic on how taxation of real estate gains works and how the 1250 recapture works as well. Okay, so we're going to dive right into this. Now, normally in our world in real estate, we love 1031 exchanges and we love not paying taxes on our gains. However, there might be times where it's very important for you to actually dispose of a property and have the cash physically into your bank account, right? When we started off as developers, many years ago, we unfortunately had to sell all of our properties because we need to build up our capital so that we can get into bigger projects later on.
I got big plans.
So we weren't able to use a 1031 exchange as our initial strategy, but as you start to mature as a real estate investor and you don't have such a high need for liquidity any longer, then of course 1031 exchanges are going to be right for you. But let's talk about how a straight gain on a property would work and what the tax implications of that are. Okay, so the first concept we're going to talk about is basis. Basis is this tax concept. It's fundamentally a number that we're going to work with which determines how much losses we can derive from a property, right? So generally speaking, our losses are limited to how much basis we have in a property. It's also the calculation basis for determining what our gains are, right? And so the difference between the amount realized and the basis is going to be the amount recognized, which is going to be your gain.
It's really just about the math.
So the gain in the real estate world is actually made up of two components. The first is, generally speaking, Section 1231 gains, right? Section 1231 provides for a wonderful combination of long-term capital gains at the long-term capital gains rate of 20%. And if it's a loss, then the loss is actually ordinary and it's deductible against your W-2 wages and other operating business type of income. The second component is the Section 1250 recapture. So typically in a property that's placed into service for rent, like an apartment building, like a shopping center, the landlord is taking depreciation deductions every year during the time of its ownership for the ownership of the property. These losses are awesome because they generate ordinary losses, and those ordinary losses could be as valuable as 37%, because that's the top tax rate in the US as of the time of this video. And so they're taking these type of deductions, and every time they take a depreciation deduction, the basis of the building is decreasing. At some point down the road, you may decide to sell the property, and when you sell the property, we're going to compare amount sold to basis. So let's use this example here. You buy a building for $1 million, and over the years, you took $200,000 of depreciation charges against it. You ultimately sell the building for $1.1 million. In our minds, you made $100,000 of profit. We're comparing $1.1 million to $1 million. That should be a $100,000 gain. However, we live in the tax world here, and because you were allowed $200,000 of depreciation deductions over the intervening years, your gain is actually $300,000, which is the $1.1 million less the $800,000 of adjusted basis of your property, which is adjusted for the fact that you took $200,000 of depreciation charges in those years.
Oh, I like where this is going.
The way the gain works is it's split out into two concepts. First, the Section 1250 recapture. Okay, the $200,000 depreciation taken will come back to you taxable at a long-term capital gains rate of 25%. Very special rate just for 1250. The next $100,000 to make up a total of $300,000 of gain is going to be taxed at 20%, or whatever your long-term capital gains rate may be. Let's assume 20% just for the sake of argument here. The total of those two would result in your total long-term capital gains you'd be done. Let's use another example here. Same exact scenario, except your sale price is $900,000. Okay? In your mind, you lost $100,000. You bought it for $1 million, you sold it for $900,000, you have an economic loss of $100,000. However, in our world, in the tax world, you have a $100,000 gain. $900,000 less your adjusted basis of $800,000.
That's good.
Right?
That's better.
Yeah. All of it's going to be attributable to depreciation, which will be taxed at a 25% recapture rate. Okay? So that's generally how it works with calculating gains on taxable transactions in real estate, particularly real estate placed into service for trade or business, like rental properties. One thing you might be asking yourself is, don't I want to not depreciate it because I don't want to realize this 25% capital gains rate, which is higher than my long-term capital gains rate? Recall one thing I said in the video earlier. Those deductions were ordinary at the time of you taking those depreciation charges. The value of those charges was 37%. Okay? So for every dollar of depreciation you took, you saved 37 cents. It's coming back to you later on taxable at 25 cents, you have a permanent 12 cents per dollar tax savings here. We love that outcome. That's a great thing to do. It's also one of the reasons why we always encourage a cost segregation study in all of our properties, because we want to accelerate and pull in those depreciation charges as quickly as possible. Again, it's going to depend on your personal tax situation, and if you have any questions about whether or not this strategy should apply to you, then you should contact us here at this email, and we're more than happy to talk to you about what it'll take for you to achieve this particular outcome. Thanks so much for joining, and look forward to seeing you in our next video.